Welcome to The Explainer. Today we're cracking open the playbook, the one the wealthy use to build their fortunes and, slash their tax bills. And it's all completely above board. We're going to break down those expert strategies into a guide you can actually use.
All right, so you've probably wondered, how on earth is this possible, right? Well, the answer isn't some secret shady loophole, not at all. It's all about a deliberate, really smart, layered financial structure. And what you're going to see is that it's not really about how much you earn, but everything to do with how you set up those earnings. Think of it like a strategic playbook. We're going to break down 5 key plays, and when you start putting them together piece by piece, they build this incredibly powerful financial system that really works for you, not against you. Okay, first things first. The absolute foundation of any solid financial strategy is protection. You got to build a wall, a real firewall, between your personal life and your business risks. It's all about creating that financial shield. And the tool you use to build that wall, it's the LLC, the limited liability company. That's your shield. So let's say the business gets sued or takes on debt. Creditors can only go after the business's assets. Your personal savings, your house, your car, they're off limits. This separation is sometimes called the corporate veil, and honestly, it is absolutely critical.
So what's so great about an LLC? Well, the magic is that you kind of get the best of both worlds. You get that ironclad liability shield you'd see with a big corporation, but you also get the tax simplicity of a sole proprietor. The profits just pass through right onto your personal tax return. This is huge because it means the business itself doesn't pay taxes. You totally avoid that nasty double taxation trap that bigger companies have to deal with.
All right, so you've got your shield up. Your business is protected. But then it starts making real money. And that's great, but that simple pass-through tax system, it suddenly creates a brand new problem. And it's a very specific and very expensive tax. Yeah, this number right here, 15.3%. This is the big one. It's the self-employment tax. For a regular LLC, every single dollar of profit gets smacked with this tax to cover Social Security and Medicare. When you're just starting out, it's manageable. But as your business grows, man, this becomes a major drag on your finances. So when does this become a real problem? Well, according to expert reports, there's a magic number, around $50,000 in profit. That seems to be the tipping point where that self-employment tax really starts to bite into your bottom line. And it's basically a big flashing sign that says, okay, time for the next play. And here's the move. It's called the S-Corp election. Basically, you tell the IRS, hey, I want my LLC to be taxed like an S-corporation. This is brilliant because it lets you split your income into 2 buckets. First, you pay yourself a reasonable salary. That gets taxed like any normal paycheck. But, and this is the key, the rest of the profit, you can take that as a distribution, and that part is not subject to that killer 15.3% self-employment tax. Just making this one change can seriously slash your tax bill. Okay, so we've leveled up and tamed our business income. Now it's time for a big pivot. We're moving on to the next power play, and this one is a classic cornerstone of building wealth, real estate. But why are the tax rules for real estate so good? This really gets to the core of it. We're not talking about loopholes here. These are intentional incentives from the government. I mean, the tax code is literally written to encourage people like you and me to provide housing for others. It's designed to be a win-win. And if there's one superpower in real estate investing, it's this, depreciation. You've got to understand this. It's what people call a phantom expense. Basically, you get to claim a tax deduction for the building wearing out over time, even though no actual cash leaves your bank account. And the crazy part? While you're taking this deduction, the property itself is probably appreciating, going up in value. It's incredible. But there's a catch. Standard depreciation is slow. I mean, it's spread out over 27.5 years for a residential property.
The real pro move, the advanced strategy, is about speeding that up. It's all about accelerating those deductions to get the biggest bang for your buck right now.
And this is how you do it. This is the magic of the paper loss. Just look at this. The property brought in cash, $5,000 in your pocket, real money. But then you add that big depreciation expense, and suddenly, on paper, for tax purposes, you actually have a loss. It's a fantastic position to be in.
So how do you get these giant paper losses? The tool is called a cost segregation study. Sounds complicated, but the idea is simple. You hire professionals to do this detailed analysis of your property. They break it down into all its little pieces, the carpets, the light fixtures, the appliances, and the tax code says you can write off those smaller components way faster than the building itself. This lets you pull huge deductions into the first few years you own the place. And this right here, this is the holy grail for a lot of high-income earners. Because under some very specific rules, and this often involves short-term rentals where you have to materially participate in the business, you can take those huge paper losses from your real estate and use them to offset the taxable income from your main W-2 job or your business. This is literally how someone making a ton of money can legally shrink their tax bill way, way down, sometimes even close to zero. Okay, we're at the end game now, the final piece of the puzzle. This is the move that pulls everything we've talked about, the LLC, the S-Corp, the real estate, and ties it all together into one sleek, highly efficient system. It's called the management company. It's another LLC you set up, and its only job is to provide real, legitimate management services to your other businesses. Think of it as the central command hub for your entire operation, handling things like marketing, accounting, HR, you name it. So here's how it actually works. Your profitable businesses, your S-Corp, your rentals, they pay a management fee to this central company. For them, that's a tax-deductible expense, which lowers their profit. That money then moves into the management company, which can use it to pay for all those shared expenses, your home office, your business vehicle, travel. You can even legally pay family members for actual work they do. It's just one final brilliant layer for organizing your deductions. So when you look at the whole playbook, you see it's really about a big shift in thinking. It's not just about earning more money, it's about structuring your finances so you can keep more of what you earn. Look, understanding these plays is the first most important step. Now the real question is, what's your next move?